Well, hello, everybody. I'm Kevin Gilmore, and welcome you to this presentation today. I'm going to turn it over to Charlie in a few minutes here, but first I want to turn it over to Susan Ross Wells, our Marketing Director, to discuss a few housekeeping items.
Good morning, everyone, and welcome. Yeah, just really quickly wanted to let you know as we get underway that Charlie will present for about a half an hour, and then we'll do a Q&A session immediately following. So please enter any questions you have that pop into your mind as Charlie is speaking into the question drop down, and we will tackle those during the presentation or certainly as a follow-up. Also, just a quick note that there is a handout attached if you'd like to download Charlie's slides from today. And also, we'll be sure to send out a recording after the webinar as a follow-up, just in case you missed something or want to go back and check in on a particular item. So with that, I'll hand it back over to Kevin, and we'll get underway. Thanks.
Thanks, Susan. Before we get started here, just wanted to again thank everybody for being in on this. I think this is probably the first of what will be certainly more in the future as everything unfolds with the election coming up in here. But everything has happened so fast this year. The 24-hour news cycle keeps going in there. In the past couple of days, we've had story after story about what's going on with the stimulus bill and whether negotiations are on, off. Now the debate whether that's on or off as well. And there's a thing, the news cycle keeps us going in here, and much of it directly affecting what's happening on the tax side in here. So we're lucky to have Charlie Heid, one of my tax partners, with us today to take us through some of the planning that's going on right now. We certainly will be doing, this isn't, like I say, this isn't the last one, but we're certainly going to be having more discussions with everybody as we get through the election and know a little bit more about what's going on. But this isn't so much this isn't a political discussion in here. This is more the what if scenario in here as we look ahead to what might happen in the next month or so. After that, we'll certainly have future webinars and be meeting with all of our clients in here to discuss how we may need to react to whatever happens in here. So with that, I'll turn it over to Charlie.
Kevin, thank you very much. So again, welcome everyone. And again, thank you for taking an hour out of your day. I hope that at the conclusion, you have some thoughts about things you might need to be thinking about as we look at the implications of a number of items that we're going to talk about today. So first of all, again, I want to remind you, if you have questions, please enter those in. One of our young tax professionals, Jessica Nepper, is monitoring your questions, and at the end, I will bring her on and we will start to go through some of those questions. And I do assure you, if we aren't able to get to your question online, you will get a response back from us on your question. There just may be some that might be more entailed than giving it a quick answer. So having said that, we are going to get going on the slides. And I do want to, first of all, say that, these slides we are able to provide to you, and the insight that comes with them from our alliance with RSM, which is the 5th largest firm in the world, and they have an excellent national tax office in Washington, D.C., headed up by a number of people that have been high level at the IRS, whether attorneys, commissioners, also from Treasury, and they an excellent insight from the number 2 person who left Treasury about a year ago to join RSM. So we're very blessed that we have that insight, and that's what we want to share with you today. All right, next slide, please. And then as I get to the next slide, we're going to kick off with a polling question. And I'd like you to bring that up. And I'd like to gauge the audience as far as how closely you've been following the two camps and their tax policy. So your choices are, yes, I've been following the campaign tax platforms. No, I'm not sure where the campaigns stand on tax policy. And again, this is where you can find this, is if you can go out to either of the candidates' websites and you will find their tax policy listed. And so let's just give it a couple more seconds. All right. Kelly, there, oh, you missed the, there we go. 67% have been following, fantastic. So a lot of the, what we're gonna be talking about, you should be familiar with. Now we'll probably, hopefully get into some more details that you weren't familiar with. And that should be very helpful. So let's get back to the slides. All right, so I want to start off with, before we jump into the various plans, let's really talk about, how is ultimately tax policy, how does it become law? And well, let's start with the makeup currently of the two chambers, the House and the Senate, and also the two major storm clouds that are brewing that are going to affect taxes and tax planning for the foreseeable future. And that is obviously, as we're talking about federal elections, we're under 30 days to go. The president, the congressional, both House of Representatives and the Senate, you'll see all of the House is up for re-election and 1/3 of the Senate. Then we've got the fiscal response to COVID-19. And we're all living this. And as Kevin had spoken to, I mean, this is a 24-hour news cycle that started back in late February. And again, it continues. So this is one that is going to influence what goes on with taxes, no matter who gets elected. And we'll talk about that. So next slide, please. Advanced slide, please. There we go. Okay, thank you. So let's talk about the election and what's coming up. So in the House, we have 33 seats that are considered at risk for the Republicans, 42 seats for the Democrats. I think what's important to realize is if it were come to fruition that each party lost the seats they're at risk for, the Democrats would still be in control of the House. And I think that's important to realize, because at least if you're following any of the polling, and you may not put a lot of credence into those polling numbers, but they're all generally consistent that it doesn't appear the House is in play to flip to the Republicans for this cycle. So we just want to keep that in mind. Then when we get to the Senate, this is interesting. From a Senate standpoint, we have 23 Republicans that are up for re-election, and we have 12 Democrats. Now, what's interesting is I think at the beginning of the year, we would have felt that the Republicans were pretty safe, but as the year has progressed, more and more of those Republican at-risk seats have really moved into a higher level of concern. So again, the Senate does appear to be in play. The key here is Republicans can lose 3 Senate seats on a net basis and still maintain control, provided they keep the White House, because obviously Vice President Pence would have the tiebreaker vote. And highly unlikely that the Democrats will be able to pick up the 60 votes needed to defeat a filibuster. But it's highly likely that the Democrats could take control of the Senate, have both chambers, then it comes down to the presidency. When we talk about, next slide, please. So let's talk about, as far as, we've got the election, we've got all three branches are up. And then how does tax policy actually become law? I mean, again, I'm going to give a quick oversight because it's kind of changed as, the political parties have gotten so tight in the Senate. So it starts with Congress, the House and the Senate. Then we have the administration, the president, then Secretary of Treasury, Assistant Secretary of Tax Policy, the IRS Commissioner, and Chief Counsel of the IRS. Those administrative positions drive the tax policy working with Congress. When we talk about tax policy, we're talking about what is deemed regular order. And folks, we haven't seen regular order in a long time. That is, it starts with a bill with the Ways and Means Committee in the House, goes to the full floor of the House for approval, and then moves to the Senate. And the Senate would then, the Senate Finance Committee would take that up and then take the bill to the floor of the Senate for a full vote, requiring 60 votes to pass. As you can imagine, that just hasn't happened in recent times because, as I pointed out, currently you saw there's, with the Democrats and the Republicans in the Senate, it's so very close, not enough to get to that 60 vote. So how legislation moves forward is what's called reconciliation. And this is often called the Byrd Rule in the Senate. And it is essentially, you can pass tax revenue measures with 51 votes, not that super majority of 60 votes. The main limitation on this strategy, and as we'll point out, is it can't increase the deficit after 10 years. So when you look at a number of the Tax Cuts and Jobs Act statutes as related to rates, related to limitation on itemized deductions, all of that stuff sunsets. And that is a direct cause of using the reconciliation process. It has to be gone after 10 years to not increase the deficit. So I think that's important to understand that process as we now move to the next slide, where we talk about scenarios. So when you think about, Treasury has been extremely busy in 04. Coming into 04, focus was on tax reform implementation. And what I mean by that, issuing of regulations to go with the tax reform that we saw, the Tax Cuts and Jobs Act that was passed in 2017. We went through most of 18 without a lot of guidance. We started to get proposed regs and then obviously final regs. Well, that was the focus, and then COVID hit. And obviously Q2 was all about getting stimulus packages out to support and help to get a lifeline to businesses in the US. And that's really took over second quarter. Third quarter returned back to issuing regulations and getting those final regs out on items such as the interest limitation, the new 163J code, the 199A, which was the qualified business deduction. All of those need to have regulations to give guidance to taxpayers on how they were to interpret the law. Then we come into Q4, and by all all right, this is the most important period that we're looking at because we're entering an election and we're going to have to deal with stimulus that is still yet to come. As Kevin talked about, we thought we might have a bill, then we weren't going to have a bill, and then it was back on, and then, you know, we ended up, no, we're not going to deal with it till after the election. So a lot of issues going on, and all going to be relevant as we look at the three scenarios as far as how this election could go. Next slide. So let's focus in on scenario 1, 2, and 3. Now, first of all, let's start with scenario 1. And this is where it's a complete Democratic sweep. And if this scenario were to occur, we would be looking at, most likely in 2021, significant tax legislative changes that would be likely. The question is timing relative to the economy. But scenario 1, based off of today, is highly likely, and the Democrats, as I had said, when it comes to the Senate, more than likely are not going to get the 60 new seats they would need to be able to control that. So it's going to be using reconciliation in scenario 1 to get tax laws to move forward. And that's going to, you know, largely play on, you know, you're going to need some help there. So scenario 2, I'm not going to spend a lot of time on this because, as I already said, the House doesn't appear to be in jeopardy of changing control. So scenario 2 is unlikely. But let's jump to a scenario 3. So scenario 3 is really probably where we're all going to be, and that is that the Republicans will keep the Senate but might lose the White House, or the opposite. They lose the Senate and they keep the White House. Either way, if scenario 3 occurs, what we're going to have is less dramatic tax changes. But I do think it's important to understand on scenario 3 that if Vice President Biden is elected president, scenario 3, even though he doesn't have the Senate, he can still get things accomplished because, as I had talked about, the Treasury Secretary plays a huge role in the development of tax regulations. And so as long as those regulations are issued under the intent of the law, things can occur that can raise taxes without having to go through Congress to make it happen. And I think that's important for everybody to understand that Vice President Biden would appoint his own Treasury Secretary and be able to advance some agendas on his tax legislation, even if he doesn't control the Senate. Let's go on to the next slide, please. So let's get into the heart of it, and that is following the tax policies. So I just want to, let's jump to the Republican tax plan. Largely, I think everyone understands that they just passed a major tax bill called the Tax Cuts and Jobs Act, which we're still implementing here in 2019. But the key is that was their signature legislation, and that really has really become part of the key policy for President Trump in his policy. The only difference is maintain status quo, but he wants to make the rate changes that were accomplished in the Tax Cuts and Jobs Act. He wants to make those permanent, both for the individual rate decreases and the capital gains tax rate. He has mentioned a potential further middle class tax cut, but that really on his website, that's all it says. There's no detail what that means as far as, is it rates? What, you just can't tell. But He clearly has a focus on the middle class. Then we come to Vice President Biden's tax plan, and obviously there's a lot more detail to Vice President Biden's. And again, I think if you heard the debate last night, I mean, I heard some comments back and forth, you're gonna, revoke Tax Cuts and Jobs Act. It's kind of funny. I always say both parties should just go out and look at their own candidates' websites because they might get a better idea. So if you go out to the website, here's where Vice President Biden's policy, and again, this is policy, it's not law, and it's going to change multiple times before it would ever get to a policy level. But his insight right now is he wants to increase the corporate income tax rate, which was just reduced to a flat 21% in the Tax Cuts and Jobs Act. He wants to take that up to 28. Now, again, 28 is higher than 21. And, when that passed, even the Republicans said, wow, the 21%, we weren't even expecting that. We were thinking, 28, maybe 24. So it went to 21, which is great. It's a very competitive rate when you consider around the world. He's talking about he wants to take that back up to 28%. The next item, if you remember, the Tax Cuts and Jobs Act eliminated the alternative minimum tax for corporations. He wants to bring back a form of alternative minimum tax, and it's called he wants to do it based off a minimum tax. And what this is this would apply a 15% tax rate to those corporations that have book income. So applicable financial statements, book income of 100 million or more would, even though they might not be paying any federal income tax due to NOLs, whatever, for book purposes, they had income, and he wants to establish a minimum tax on that level. I think as far as this has been dubbed the Amazon tax. Pass-throughs, and I have this here for business because we're all very familiar, as most of our clients are S corps or partnerships. Obviously in the Tax Cuts and Jobs Act, we were very interested in the pass-through deduction, the qualified business income deduction, which is the new code section 199A. So Vice President Biden, in his plan, he isn't eliminating it, but essentially he does eliminate it from this standpoint. You only get the benefit of the 199A deduction if your earnings are 400,000 or less. I know a lot of the clients I work with, the income that flows through from the S corp is well above 400,000. And so those, the owners of those businesses wouldn't get to take advantage of the 199A. Again, hopefully there's some negotiation if this, depending on how the elections go, because I do think the 199A needs to be there, and people need to understand that, owners are paying the tax for the entity, not person. It's not a personal income to them. Then we get to individual rates. And there are certain components, as I already talked about 199A of the Tax Cuts and Jobs Act, that could be repealed or modified. But when we talk about individuals, one of the items that Vice President Biden wants to change when it comes to rates is in the Tax Cuts and Jobs Act, the top marginal rate went to 37%. Down from the 39.6 prior to the Tax Cuts and Jobs Act. Vice President Biden said he wants for that top income bracket for high income earners, he wants it to go back up to the 39.6. When it comes to long-term capital gains, we've got a top capital gain rate of 20%. And it could even be 15 or 0, depending on your income level and the amount of capital gains. That's under current law, under the Tax Cuts and Jobs Act. What he's talked about is the elimination for income in excess of $1 million, that the capital gains rate would now just be based off your marginal tax rate, which at that level would be 39.6. So you're talking about an increase of 20% in additional taxes on capital gains, again, if your income is above $1 million. Now, we hear about the Social Security. This is new. This is in Vice President Biden's plan. And what he's talking about is, everybody knows right now that Social Security tax, the 12.4, which is split evenly between the employee and the employer, that split is caps at $137,700 of wages. Then it stops, and then you're just paying Medicare from there. Well, under Biden's plan, you would still have that first tier up to the 137. It would then stop, but once your wages get above 400,000, this additional 12.4 would kick in. So I think that's important to just know that that is out there. When it comes to estate and gift, I just want to, on this one, all that Biden has said. So if you know, right now, everyone's got a large exemption, 11,508,000, that they can move tax-free to heirs. So essentially not have a taxable estate. And then the heirs get step up in basis on their assets. Vice President Biden, and there's not a lot of details, but what he has said is he wants the estate tax to go back to historical norms. Well, what does that mean? Does it mean the rate? Does it mean taking that 11 million down to maybe 1 million, or to 3.5? What does that mean? But he was very clear he wants to eliminate the step up in basis for inherited property. And that could be huge, because when you think about it, heirs would be then paying capital gains. And as we talked previously, capital gains rates go up. There could be a lot of tax in that scenario. Also on itemized deductions, nothing has been said as far as the reinstituting the state and local income tax and getting rid of the cap at 10. He did mention at one point in 2019, but there's nothing on his website specifically on that. What he does say on itemized deductions is that he's in favor for, again, high income earners, and they define that as 400,000 or above. You would be limited because they would bring back the P's limitation on itemized deduction. So the overall benefit, you would be capped at a 28% benefit on your itemized deductions. So let's move to the next slide, and let's talk about what does all this mean from a planning standpoint. So when we think about normally, over the last several years, all planning has been focused on deferring income and accelerating deductions. Well, when you look at the potential for rate increases, the key is the opposite. We want to accelerate income and defer deductions. So let's talk about that. Let's just say, here's an example. Let's say you currently have an installment agreement that is playing out. One of the things you should be looking at is, should we terminate that installment plan and accelerate the income into 2020 before rates go up? Second, transaction related. Whether you're currently in the process of selling your business, whether you're contemplating selling your business, this is something, these rates are something to take into consideration. As far as pulling forward the taxable transaction, if possible, to close before the end of the year. If you are currently negotiating an installment agreement as part of that, maybe you rethink that and want to get the cash up front. Accounting methods. There's a lot of different method changes, a lot of things to look at, but the key is focused in on those methods that might accelerate income and allow us or defer taxes or deductions to the future. To me, just a really quick example of how that 481 could work is, and let's say you're a company out there and you're still using the LIFO method and you've built up a large LIFO reserve. 2020 may be the year you want to do a method change and terminate your LIFO. Bring that LIFO reserve into income in 2020 to essentially avoid the potential for that being taxed in the future. That would be just a quick and easy example. Depreciation. Normally, we're always out, we're talking about at the end of the year, capital expense plans. Can we get something ordered and placed in service before the end of the year to take advantage of bonus? Well, given what might occur on election night, that's something to rethink this year. Do I really need bonus depreciation? If I've already made capital acquisitions, should I be looking at electing out of bonus on a class by class basis? If I haven't pulled the trigger on making an acquisition by the end of the year, maybe I delay that and do that acquisition in 2021 when the deduction is going to be worth more to me. And then last is really on your investment withholding or holdings is where do you stand on a long-term capital gain? Do you have a large amount of unrealized gains? Should you lock those in now in 2020 and pay the tax versus running the risk that the capital gains rates dramatically goes up in 2021 and beyond, and the tax burden would be much higher. Next slide, please. So on this one, I just really, I don't know how many people in the audience are going to have foreign implications, but I do think the one item that was clearly in Vice President Biden's tax plan, and that had to do with the GILTI rate, which is the global intangible low tax income tax. This is, when you think about this, was you have foreign operations, it's a controlled foreign corp. Prior to the Tax Cuts and Jobs Act, that income, unless you repatriated it through a dividend back to the US, you paid no tax on that income. It was just deferred. It just built up overseas. Well, Tax Cuts and Jobs Act changed that and added this GILTI provision, which essentially went and taxed at an extremely low rate your accumulated income from foreign operations, and then on a go-forward basis, you're paying this GILTI tax going forward. So you're paying tax currently. Vice President Biden wants to take it from the 10.5% that it is currently to a 21% tax bracket, or 21% tax rate. So that's a large increase, coupled with the fact that corporate rate he wants to take from 21 to 28. So again, the planning here would be to look at your structure, especially if you have blocker structures where you have a controlled foreign corp. Maybe you want to look at what's the benefits if I were to do a check the box election and make it a flow through structure. So again, planning out there and available, there always is. It's just something to be thinking about. Next slide, please. So the one thing, this last slide, I think it's important that we also consider, we've been all talking about the policies of Vice President Biden compared to President Trump. And I think it's important to really also identify we have this other factor, this COVID-19 and the impact it's had on our economy, especially at the state and local level. When you think about, without significant influx of federal funding, which I think it's safe to say that given what we've all read as we watched this stimulus discussion play out, it's highly unlikely they're going to, state and local are going to get any kind of significant, meaningful help from the federal government. So they're on their own. Having said that, how bad is it? Well, as of August, the 600 billion revenue shortfall is where states were at, and that's just going to continue to grow. You could tack on another 150 billion for local tax that's not even in that number. This isn't political. I mean, it's just basically, this is the single largest fiscal disaster that state and local has seen in their history. It is. Unlike the federal government, states don't have the ability to pass budgets without them being balanced. And so that means that as Ohio and Michigan come into their biennial budget discussions, they are going to cut expenses wherever they can, but it's just not going to be enough. So you are looking at changes, additional revenue raisers that could be coming. And again, we're talking the majority of state revenue comes from individual income tax, sales and use, property tax, and gross receipts tax. You are going to see across the board, there could be increases in rates. There could be elimination of deductions. I'll use the perfect example in Ohio. A year ago, we saw them, Ohio was looking at eliminating the small business deduction, which again has saved a lot of tax dollars and allowed that money to go back into the economy. They may have to eliminate that. So it's something to consider. When you think about sales and use, Ohio in the past has looked at expanding the sales tax to include services, professional services, legal, accounting, consulting services. That may be back on the table. You're going to be looking at potential increases in rates, property tax. Again, gross receipts. Ohio has the commercial activity. When it initially passed, it was a broad-based, low tax rate. Well, Ohio, they could be looking at raising the tax rate on commercial activity tax. I can tell you that at least from the OMA standpoint, they will fight that, and we should all be backing them for that. But it comes down to they've got to find the money some way. So we should all be, it's not just the federal level we're looking at, it's state and local that is going to play a piece in all of this. Next slide. All right, so with that is a quick walkthrough of kind of where we're at, what we're dealing with, and what the implications could be. With that, I'm going to bring Jessica Nepper on, and Jessica is going to share if we've received any questions to date. And again, as I said, if we don't get to your question, it's probably because we couldn't answer it quick enough, or overall we didn't get enough similar questions, but we will get back to you personally.
Hi, Charlie. Thanks for having me. We had a couple questions from the audience. The first one was they wanted you to run through the pass-through piece of Biden's plan again.
Sure, absolutely.
Kelly.
So what Vice President Biden has proposed when it comes to 199A, so that is the qualified business income deduction. Right now, you know that when that income flows into your personal return, you're getting 20% tax deduction on that income. It's an actual deduction on your return. What Vice President Biden has proposed is if your income is $400,000 or less, you still get that deduction. If your income is above 400,000, you would not get that deduction. So essentially, he's eliminating the 199A pass-through deduction that we currently have. And if you remember, that pass-through deduction came in with the Tax Cuts and Jobs Act when they lowered the corporate rate to 21% and then lowered the top marginal rate for individual to 37. That's a huge gap. And what they did is the pass-through deduction was a way to bring that overall effective rate in from the top marginal of 37 roughly down to about 30%. And 30% compared to 21 isn't as bad as, 37% compared to 21. So again, Vice President Biden is talking about eliminating that if you're above 400,000. Oh, Jess, you're on mute.
Sorry about that. Okay, so our next question leads to, with regard to the Social Security tax, would the tax apply to people who have K-1 income that exceeds the 400,000?
That's a great question. Yes, I should have been clear on that. It applies to both earned and self-employed income. You're on mute again.
I'll get it next time, sorry. Okay, so it took the Republicans 2 years to change the tax code. If the Democrats win the House and the Senate, is it possible that the tax change could take 2 years as well?
It's a great question. This is, and I'm going to just share with you when I went through this presentation with RSM and had the newest member of National Tax who came from Treasury, who is the number 2 in Treasury before he left to join RSM. That question was posed, and here's what he said. If scenario 1 comes to play, where the Democrats get both the House and the Senate and the White House, he said we could be looking at October for how quickly these changes could be made, October of 2021.
Okay, thanks, Charlie. Another question we have is, on the last slide, we discussed state and local tax changes. A lot of our clients are local here in Ohio. How likely do you think Ohio's tax structure will change? And another question that's related to this is, do you know what the projected Ohio deficit is?
I do not know what the projected Ohio deficit is. I actually thought about that last night, and I should have reached out to the OMA to get that. We will get that answer out to you, because I do think, as all of you are starting to think about the implications, we should know where Ohio's at, and we'll also try and get Michigan for you, and we'll send that out to the entire audience. No, I have not heard anything yet as far as changes that Ohio, but again, a lot of things have been, kind of on not lockdown, but, delayed with COVID. But as they come back after the elections, it's going to be front and center, and it's going to move quickly. And am I personally expecting that there's going to be increases? I think there has to be. I mean, and I'm saying this from a standpoint of, no matter who gets elected, rates are going up. When you think about the debt load today at the federal level is the highest it's ever been since World War II. What happened right after World War II? And again, this is before my time. I do want to clarify. But I do want that rates went up to help pay down that national debt. In this case, that's going to happen. Rates are going to have to go up. You can't continue to cut tax rates and incur the kind of debt we're talking about. On a state and local level, there's going to be change. I mean, let's face it, you can't have the fiscal crisis that state and local are facing and not see taxes go up to help cover that. So you can plan on, no matter who gets elected, that taxes are going up. Now it's just a matter of getting the details to the plans.
Thanks, Charlie. Next question, what is the most significant difference in estate taxes that you see between the two candidates?
The most significant difference that I see between the two candidates is one essentially has increased the estate tax exemption to such a large amount that the majority of estates will go tax-free. That's President Trump and the Republican Party. Also, they're allowing assets to transfer to the next generation with that step up in basis. Vice President Biden, his plan is to take estate tax back to historical norms, which would mean that exemption isn't $11 million, it's $1 million. So there would be taxable estates. And if you remember at one point, the top tax rate for a taxable estate is 55%. So that transfer of wealth from one generation to the next could be greatly jeopardized.
Thanks, Charlie. I think this leads to another great question. So say I'm planning to retire and passing the business on to my kids. What steps should I be taking now in order to create the best strategy for that?
That's a great question. What you should be doing right now is, one, talking to your attorney as far as the planning, talking to us about getting a valuation for your company, and really start to hammer out the plans that you want to enact and get them done in 2020 to avoid any kind of concern that this could, if a bill's passed in 2021, it could be retroactive to the beginning of 2021, or it could become effective in October. So anything you get accomplished in 2020 would be protected under the current law.
Thanks, Charlie. Looks like we're all set on the audience questions. I know you went over this previously, but just to reiterate it, say we are planning to have a large capital expenditure in 2021. What is the best strategy for our company? Should we wait till 2021? Should we do it now? I know we went over it, but just to go over it again.
Yep. So first of all, I would wait until after November 3rd. So we know, we kind of have a clear picture of really what we're dealing with. And then two, if it turns out that scenario one does come into play, then my advice would be on that large capital expenditure. If you haven't pulled the trigger on it yet, I would wait till 2021 to do that. If you don't have other business reasons to get it done in 2020. If you've already pulled the trigger, then we need to really look at, do I elect out of bonus? And what I meant by class is you can't pick and choose the pieces of equipment that you're applying bonus to. If it's all 5-year property, you have to elect out of the entire class of 5-year property to do that. So again, what it really comes down to is on the bonus and capital expenditures is, if you can delay, I would at least, until we see where the election's going. And here's the concern. The other issue that I didn't even talk about earlier is we may not know on November 3rd who won. It may be a few weeks. And then the year end's getting tight. So it's time to start having these discussions now, because you may not have enough time to pull the trigger on something, when you're down to, it could be, mid-November before we, know, or the end of November, if that's worst case scenario. So it's just prudent to start laying out the what ifs right now. And again, we're happy to help, and we will be having individual meetings with every one of our clients as we come out of the election day to really focus in on what needs to get done.
Thanks, Charlie. That looks like it's all for audience questions at this moment. If you guys think of anything else, feel free to email me on the slide. I can get you with the correct partner or answer your question directly. Charlie, I'll turn it back over to you.
Okay, thanks, Jess.
Thanks.
So again, I want to thank everyone for taking the time today to join us. We will continue to send out information as we get it from RSM National Tax. I think, I feel very blessed that we have their insight and their connection to the current administration and Treasury. That's very insightful. And again, thank you. This will be, I'm sure we'll be doing many more as we see things advance. And we will get you that information on where's Ohio's current deficits stand and get that out to the entire group along with Michigan. So again, thank you very much and have a great day.